In today's video, I will break down what happened to Silicon Valley Bank, its implications for crypto, and other major financial news stories. Let's get started. Hey guys, I'm Ryan, and it's good to be back. As I'm sure many of you noticed, Dominique and I have been on a little bit of a YouTube hiatus, mostly because we have been really busy planning our wedding. We're both super excited about it, but we decided that this break has been long enough and that it's time to get back to start sharing content with you all again. So without further ado, let's dive in. Silicon Valley Bank, or SVB for short, was founded almost 40 years ago in 1983. It was known for catering to the tech industry, namely venture funding in tech startups. However, it suffered a catastrophic failure last month on March 10th. But what exactly caused this bank to collapse? Well, it turns out a combination of factors led to the perfect storm. SVB had been incurring steep losses since 2022 with the constant raising of interest rates by the Federal Reserve and a period of little to no growth in the tech industry. If you need a refresher on the Federal Reserve and how it works by raising and lowering interest rates, check out my other video, which I've linked here. For those of you who aren't aware, high-growth innovative tech stocks are usually the hardest to fall during times of economic hardship. Now, this is because money traditionally rotates out of the tech-heavy NASDAQ into more blue-chip stocks in the Dow Jones and even other asset classes like bonds. Many investors do this in order to minimize their risk exposure and opt for something that will give them a safer return on their investment, even if it's not necessarily a high return. Regardless, it is clear that there was poor risk management in addition to the current economic environment that caused this bank to fail. Word quickly spread like wildfire over social media that Silicon Valley Bank was insolvent and sitting on losses in excess of $15 billion. Sure enough, the bank run was more than enough to prove that SVB didn't have enough money for all of its account holders. The resulting aftermath was chaotic, to say the least. The failure of SVB is the second largest bank failure in the history of the United States, and it shook the very foundation of the traditional finance system. Such failure is not taken sitting down, so members from the Federal Reserve and Federal Deposit Insurance Corporation, FDIC for short, quickly stepped in to ensure all account holders. What's interesting is that most of the money in Silicon Valley Bank was uninsured, about 85% of it, but that didn't stop the US government from announcing that everybody was going to regain access to their funds. Regardless if it was insured or not, clients who even deposited more than the $250,000 FDIC limit would be able to get back all of their money through the establishment of an FDIC bridge bank. Ultimately, the collapse of SVB dealt a huge blow to consumer confidence in the traditional banking system. The irony is that while Silicon Valley Bank was the most talked about in the news, there were actually a total of 3 bank failures in March. There was Silvergate Bank, which failed on March 8th due to its large exposure to disgraced crypto firm FTX. And then 2 days later, there was Silicon Valley Bank, of course. And then 2 days after that, on March 12th, Signature Bank collapsed, which was actually the third largest bank failure in US history. Now, these banks aren't alone in their financial troubles. According to researchers from Stanford, Columbia, Northwestern, and the University of Southern California, there are another 190 banks that are at risk of failure if only half of their uninsured clients withdraw their funds. First Republic Bank and Credit Suisse have also been making headlines lately, as they also took large hits from clients moving their money to other places. First Republic Bank had outflows of $70 billion, resulting in a number of credit rating downgrades. The stock price of that bank also plummeted nearly 90% over the month of March. While First Republic still clings to life desperately, Credit Suisse was not as fortunate. The second largest bank in Switzerland technically collapsed, and it was bought out by its rival, UBS, for around $3.3 billion, a fraction of what it used to be worth not that long ago. While this technically kept Credit Suisse going a little bit longer, UBS apparently plans to sell off parts of it in the coming months and years. It is clear that this financial crisis has had everlasting impact on various regions of the world, including Switzerland's reputation as a global banking center and the United States here at home. Such a rash of bank failures definitely did not help the markets. Cryptocurrencies initially shot up in value as people flocked to find different alternatives to fiat currency and store of value. Obviously, while crypto still carries a great deal of risk, more people are starting to believe that holding it might be a better store of value in the long run instead of keeping money in a bank account. We're already seeing that mindset in other nations as they make moves to lessen their own reliance on the US dollar. As the dollar weakens, other assets start to look more attractive as a store of value. It is not surprising to see countries like Russia and China attempting to weaken the US dollar, but other countries have joined in on this effort as well, namely Singapore, Brazil, Argentina, the United Arab Emirates, India, and even Saudi Arabia. Some of these efforts revolve around trading non-oil commodities. And now, while the strength of the US dollar isn't something that is going to crumble overnight due to these measures, they overall still contribute to a decrease in the dollar's purchasing power. Definitely something to keep an eye on in the coming years. Switching gears to more crypto-related news, we saw a bit of a relief rally in the month of March, but that hope is starting to stall out a little bit as investors weigh persistent inflation and rising inflation rates. It's looking more likely that the Federal Reserve may continue to raise interest rates, reigniting concerns about a possible recession. Bitcoin is struggling to go past the $31,000 level and has once more slipped back into the high $28,000 range at time of filming. It's true that this area will act as resistance for quite a while, as it used to be a crucial support level. The macroeconomic factors certainly don't help either, as that further suppresses the price. However, Bitcoin is still doing very well despite some people spreading fear, uncertainty, and doubt. It's been up over 30% in the past 90 days, but now that it's just down 5% in one day, those same people are panicking. Nothing goes up in one straight line forever. That's true of anything, even stocks. There are pullbacks and there are corrections that always occur, and that is perfectly normal for short-term price action. Now, the bank collapse has also harmed the crypto industry because it causes crypto firms to scramble to find reliable banking partners. For our next story, Hong Kong is still trying to become the next cryptocurrency hub. As of April 19th, a Hong Kong court declared that the crypto will be treated as digital property. They claim that it is legally capable of being held in a trust, and that the definition of property is meant to be applied in a wide meaning. This puts crypto in line with other intangible assets like stocks in their eyes. For the record, it's also worth noting that currently the US Internal Revenue Service also treats crypto as property. Now, following the threat of expansion into the cryptoverse, Coinbase recently acquired a license to operate in Bermuda, especially as US regulators seem to have become hostile towards the crypto industry. Apparently, Coinbase is planning to launch an offshore derivatives exchange as early as next week. In addition to Bermuda, Coinbase has also disclosed that they plan to expand operations in Abu Dhabi. Could they potentially be preparing to relocate their headquarters overseas? Who knows? It certainly makes sense as the US has continued to attack crypto with their policies and the lack of clear regulations. Now for our last story, Ethereum has finally finished a key software upgrade. There were no issues with implementing the hotly anticipated Shanghai upgrade. But what does it do? For many of those who had locked up their Ethereum by staking it, now it can be unstaked and withdrawn anywhere. There is a cooldown period, of course, as it can take a few days to weeks for the withdrawal process to start. Overall, though, it certainly was a welcome change. Be sure to send your Ethereum to cold storage once it's unstaked if you choose to do so and available to send. Well, that's all for this one, guys. I hope you learned something new today. It's so great to be back bringing you the latest financial and crypto news. Stay safe out there and remember to diversify across and within asset classes. As always, remember to follow us online on Instagram at Coffee and Cryptos if you haven't already. Until next time, it's back to wedding planning for me. I'll catch you on the next one. See you around.